The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organization mentioned in this podcast.
Hello there, and welcome to Talk Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. So, George, what's caught your eye in the last few weeks?
Oh, I don't think I could see the last few weeks. I'm just living in the here and now.
It's that good, is it?
This is a dreadfully macrocentric year, and the whole higher for longer equals lower for longer. And we've had news about, stalling UK recovery, plus the whole US side, the rates reduction there being pushed out and saying only one for this year now. More parochially, in London, we're in the middle of UK Tech Week. That's 45,000 attendees. I mean, it is organized chaos, and I guess you need a sort of a city showcase event. But today, we also have a showcase event. That's the Small Cap Awards. Probably not 45,000 attendees, but clearly our best to all of the nominee companies.
Are you a judge on this? You're usually a judge on these sorts of things.
Not this one. The full nominee list is on the website. The one that caught my eye, I have to say, was Beeks Financial. Shares there are doing so well this year, plus 74%. Great story in there in terms of structural drivers. But I better not say too much about them because I don't know if they've won or not. It does remind us that small companies having a little bit of a renaissance at the moment. Typically, from a theoretical side, they do well in the early stages of rate reductions, more exposed to the local economy. But also the sort of the TSR from small companies. Let's define small companies as being less than 300 million market cap. In terms of TSR, that's plus 11.4% year to date. And that reverses a 9% fall last year, so that's positive. But we can also, in fairness, see it from FTSE Small Cap Index, that's plus 6% this year. But anyway, Ian, I see that you've been busy with results. Reading your research, you've had Oxford Metrics, where you've been talking about healthy growth and good execution there. But you also had Idox and a print there as well. I guess with Idox, everyone is interested in geospatial. Any thoughts there in terms of those two, Ian?
Well, there's a common theme in the terms of geospatial between the two. Oxford Metrics, nice set of solid numbers in line, bit of a tough comparator to come against from the first half of 2023. But I think the thing that's not the share price is it's got a great big pile of cash that it's going to spend. The issue with geospatial is that where did it get its big pile of cash from? It got its big pile of cash from selling Yotta, its asset location and management software business, a couple of years back, and got £52 million from that, from the VC world. And on the other side, Idox, doing very nicely, sorting itself out, now very much in sort of flight mode, and that's on an acquisition path. And where is it acquiring? Well, it's acquiring in the geospatial space, where it sees a lot of value in bringing together its skills in property, assets, understanding what customers want. So we've got to sort of compare and contrast there, but both companies are very much on an acquisition trail. And this is sort of what came out of it for me, not so much for what's happening with the businesses as individual businesses in the market, but what's happening compared to the wider small cap market and what small caps are all about. These two businesses are out there. They want to do acquisitions. They're in positions now to do acquisitions because one of the things that came out, or rather didn't come out in the meetings, was the analyst traditional question in the last few years has been, are the VCs and the private equity boys and girls, are they looking for realistic prices now? Well, it now would appear that that is the case, that we're now actually going to get a flow of companies back from private equity and from the VC market into the public market, and we can get a virtuous circle going, because for the last few years, it's been a ridiculous standoff where public equity hasn't been able to do deals because it can't afford, because of this weird and wonderful stuff going on elsewhere. I think normality is returning, and with that, the whole sort of growth prospects of small cap.
Do you know what else is returning, Ian? And that's bad news. I don't know if you saw, we had a trading update this morning from Tracsis, but basically rail transport industry being the customer set. Anyway, they've warned on pre-election restrictions impacting government and train operating company decision-making. And that's caused projects to be rescheduled. So orders that they expected, their year end is 31st of July. That drifts. In the small print, they've also mentioned a slippage in its North American sales pipeline. Now, they also have an election, but that's a little bit further away. Anyway, unsurprisingly, shares are getting smacked today, currently down 12%. Also on the poor news front, RWS, Content Translation Services.
Yes.
They acquired SDL back in August 2020. Shares are poor this year, down 19% year to date, but also in fairness, poor last year, down 46%. The H1s had revenue minus 40%, PBT minus 40%, cash conversion minus 55%. So if you love downy numbers,
they're still available.
Yeah. However, the real story in here is about the negative that Gen AI, and here more precisely, you should really say ML or machine learning, is having in terms of automation and previously human processes. However, Ian, speaking of Gen AI, I see you've been on the blogging front again.
I've been blogging again, yes.
Cisco and NVIDIA, I've got to say, you sort of killed me with your comment. Investors think that they are buying the trend when in fact they're buying the company. Ian, that hurts so much.
Well, it's one of the things that, having been a fund manager, it's difficult to actually look at every single company. So sometimes people do end up buying the trend, buying the story, buying the theme. And to a certain extent, perhaps some of the companies we mention could be described as assembled theme companies rather than focused, coherent business cases.
Then you moved on to talk about how their customers' behavior might change. If AI doesn't live up to expectations, Ian, well, what are you doing?
What am I doing? Well, there's a lot of very interesting commentary coming out of this whole sort of Cisco versus NVIDIA comparison, and it does make sense, but it makes more sense when you were actually there at the time, which I have to admit that I was with Cisco. So when we were going back 2000 odd, there was a fundamental difference between these two companies, and that's on the sort of who is behind them and what's the story behind them. Because Cisco, it was the big internet story. NVIDIA, it's the big AI story. But when you look at who the customers are and who's behind the customers, it's a very, very different story. Because, AI may disappoint, but when we look at who was backing up Cisco, well, Cisco was effectively an equity investment and debt-funded customer base. Lots of telecom companies, internet companies, it was all very exciting, but it was being driven by debt and equity, fresh equity, really. Whereas when we look at who's behind NVIDIA, we are looking at the likes of Microsoft, the likes of Google, the likes of Meta. These companies have got big piles of cash. So even if AI does go wrong, they're not going to pull the plug on AI just for a bit of disappointment. It's going to be a different fail process, and that's a bit harsh to say like that. But if it were to fail, it's going to go in dribs and drabs. The shareholders stroke investors aren't going to tell them to pull the plug. So I won't say managed decline, but more a dawning awareness, should we say, amongst investors, rather than the big slap in the face that we saw back in 2000 when we realised that we were all hoping for everything on the back of telco companies that could go bust and did go bust, and internet companies that could go bust and did go bust. So there's a fundamental difference there that makes me feel comfortable.
Ian, it's great that you've got the lived experience as an investor of the time. However, let me give you a word you haven't heard in 25 years. That word is Wintel. And Wintel, as you can recall, was the fusion of Windows and Intel. And of course, at the time, the industry was really sort of Simtel, in the sense it was a magic triumvirate of Cisco, Intel, and Microsoft. Have PC, have application, have connectivity. The ecosystem was the thing. One of my concerns is that I'm not seeing that ecosystem build around NVIDIA. Now, what you can do is say Jensen and the team there are building their own ecosystem, because it's not just a story of the semis. It's also the story of CUDA, which we've mentioned on the podcast before, but that's the underlying software platform to get developers building. So I'm saying two things to you. First of all, I think it's way too early to call a line under it. But also, I mean, the investor community still needs to look wider for that ecosystem effect. Anyway, Ian, we've got to end on a high point. We hit the Raspberry Pi IPO this week. So first for London, shares are up 43%. London is a market that prides itself on price discovery. So did the company and the advisory team, did it just get it wrong? Is it too illustrative of the anxieties in order to create a success? I know you've expressed some ideas and thoughts on Raspberry Pi. Have you updated since the rally post-IPO?
My feeling is that I think, as with all these things, you have to let it settle. And there are various people who have different views because of their different viewpoints. If you're coming at this as an investor, as a pre-IPO investor, you can feel grumpy about seeing 40% go up. But then again, you've got to remember, where did you put your money in the first place? They may well be up 100%. So let's not cry over too much hurt there, or lost upside for people who've already made a lot. For the fund managers, can you turn it around and can you get 40%? Yes, some people are going to get 40% out of it. And so what? That's the way the market works. You have to prime the market and get some of that liquidity out there. You never really know which fund manager is going to keep the stock afterwards. And yeah, we have the story 10 times oversubscribed. Having been a fund manager, the number of times I've heard, yes, it's 5, 6, 7 times oversubscribed. Don't worry, we'll look after you, but make sure you put in a number that's 3 or 4 times larger than you actually require. It's an odd setup. I think it is a long-term good story. I don't think the wheels are going to fall off this wagon. Maybe people will get overexcited. But one thing that I don't think is going to happen is it is not going to get to such a scale that everybody is worrying about it in terms of, do I have to have this in my portfolio? It's gone up 40%. There are plenty of other things out there in the market that are going to go up 40% over the next 12 months for fund managers. It's their job to go out and find these things. They've missed one. They'll miss plenty more, but they'll find plenty more if they're doing the job right.
Very good. Actually, as you were talking there, I am reminded, in terms of IPOs, if we put the IPOs of 2023 together on an absolute basis, they are now down 35%. The cohort from 2022, they're down 2%. The cohort from 2021, down 20%. Now, that said, before chatting to you, I was on to NetScientific. That's an investor group investing in early stage tech. And their view is that what Raspberry Pi does is put London on the map, but doesn't really shift it in terms of how and what they're going to be counseling their companies in terms of their eventual takeouts and exits. Ian, anything exciting on your desk for next week? You've been working so hard in the past week. I feel positively embarrassed at your rate of output.
Not really. It has to be said, we are starting to get quiet. But then again, every time I say it, we're starting to get quiet, you tell me a whole load of results that are coming out that I've forgotten to put in my diary.
Very good. Anyway, for me, the big takeaway from today was that you're giving us all an opportunity to walk in your shoes. Thank you.
Yes, I'm not sure you really want to do that, but I can show you my scars.
Thank you so much for your thoughts and sharing.
Oh, thank you for yours too, and for bringing out the problem with my NVIDIA Cisco case, that we do sometimes have a need for a common thread between all these stories.
Brought to you by Progressive Equity.